So good afternoon, everybody. Welcome back from lunch. And I think one of the topics we all need to wake up to is sustainability. So that's the topic for our discussion now. If you look at sustainability, the thoughts that come to our mind typically are the environmental related aspects. But is sustainability only related to that, or is it much more? That's what we want to learn from today's panel. On top of it, if you look at sustainability, typically the thoughts that come in our mind are related to long-term financings. So what does sustainability mean to us in short-term financing like trade finance? That's something we want to know more today. We want to know about the challenges that we face with sustainability in trade finance. How do we overcome some of those challenges? Are there any standards in the industry which can help us define what sustainable trade is? There is a lot of risks associated with sustainability, which is called as greenwashing. I think we should all learn more about it. So that's the focus of our panel, and for that I've got a wonderful panel with me today. To introduce, we've got Vineet. Vineet Gupta is the Group Treasury Manager for Dahra Holdings. Welcome, Vineet. We've got Sereen Ahmed, who's a Director, Head of Trade and Working Capital for Middle East, Barclays. We've got Silvina Bruggia, who's the Director, Emerging Markets for Refinitiv. And last but not the least, we've got George Wilson, who's part of Corporate and Institutional Banking in Investec. Welcome, ladies and gentlemen. Thank you. So to kickstart the discussion, Vineet, I want to start with you. And I want to ask you how your role as a Treasury Manager is changing with the sustainability theme. Is it just changing your strategic vision? Is it impacting your day-to-day lives? How is this impacting your life?
Thank you, Ani. So basically, just a little bit of introduction of Dahra. Dahra is basically a global agriculture and commodity trading organization.
One second. Sorry, are you guys able to hear Vineet at the back? Yeah? Okay, thank you. Please carry on.
Yeah, so basically for us, ESG, we are already in the fiber of ESG. It's not we didn't have to go, off course to basically be associated or aligned with the ESG norms, because we are doing farming. So basically we are linked to the environments and all this thing. We work with the farmers. We also work on the food security project. So basically we are taking this social cause also and associated governance. So basically ESG was always kind of a very natural to our business, which we already adopted. But irrespective of whether it's basically it's naturally blend in or not, I think ESG as a I would say activity is of importance for good cause, correct? Not only in the organization, but also on the individual level. And basically, if you see as an organization, and obviously it's a profit oriented organization, all the corporates, ultimately it should translate into some financial terminology. So for Treasury, actually, though you have a mandate for ESG and it's good, everybody should follow, still we have to actually convert it back to an opportunity where basically you can have some financial, you can translate into a financial terminology. And for Treasury, I think we found is that, there could be many ways to basically deal with it. So we are working very closely. We have a sustainability link department, which we have actually issued one of our sustainability report last year. So it's like board is very committed on the ESG. Now we basically have to make sure that this ESG doesn't become like a tick in the box. You basically instill that ESG discipline in every area of the organization, and basically you find the ways to optimize and improvise on our existing arrangements using the ESG, which is very much possible now. So basically what we are trying to do is that, and then how it is changing for me is that I don't want to arrange a financing, which I can arrange, but basically I want to link it with ESG. It gives me twofold benefit. One is that basically I might get better in terms of pool of investors, I can get better reach. And second thing, it basically put a discipline in my organization, because now it linked to a financial stuff, a financial number or financial outcome, which basically put a discipline that we have to follow it. We need to meet KPIs. It becomes like a reporting on that. So I think Treasury role is completely changing. It's adopting the ESG time. It's actually working shoulder to shoulder with ESG department, making sure. I'm also working to do a green financing framework for Dahra. So basically, we map what we are doing in terms of ESG is also linked to basically what I do financially for the company. So basically any facilities linked to those KPIs, or I basically influence my supplier or my customer to basically align with my ESG agenda. So basically I basically can influence the full supply chain and basically align with the ESG. So I think we are all working for a good cause in the ESG, but basically also using that particular, I would say, activity or the mandate to basically improvise on other stuff. So I think ESG is really reshaping the treasury. You need to map your treasury activities. Now even I have a sustainability link derivative kind of transaction. So basically you can do a hedging activity which is linked to sustainability. So I think it's becoming part of everything, and I think it's for good cause. So I think it's going really well.
Vineet, thank you. I think you raised a couple of good points. So one is clearly in terms of if your role is changing, then the banks have to also adapt themselves. So I'm going to come to you, Serena, to talk a little bit more about how banks are preparing themselves to solve, let's say, Vineet and the treasurer's problems. But before I do that, maybe George, can you help us understand what sustainability means for trade finance? Because when you talk about sustainability, how do you define it? What comes in as part of sustainability, what doesn't form part of sustainability? I talked a little bit about greenwashing. What does that mean? Can you educate us a little bit more so that we are all on the same page when we talk about ESG?
Yeah, so that's right at the hub of it, I guess. Particularly recently after COP26, there's been a preponderance of the idea that sustainability equals ESG and ESG equals environment, climate, and carbon neutrality. I mean, particularly in this region and in the African region, that's really not the case. Sustainability, I guess, originally comes from the UN 2017 sustainability
goals.
Development Goals. And a very important part of that is not just the carbon neutrality and the climate. 13 of those 17 goals look towards things like food security, reduction of poverty, development, economic development. And there is a tendency, which we'd hope to avoid, where people just look at the environmental and the EBIT of ESG when they're thinking about sustainability. That's particularly relevant in the emerging markets, but perhaps we'll talk about that a little bit more later.
Okay, so E is environmental, S is social, G is governance, right? So environmental will be all the ones that you talked about in terms of cleaner energy, more renewable energies, right? S will be social, education, uplifting of the poor or education related goals.
And inclusion.
Yes,
Yeah.
indeed. And G is governance. How do you give better governance? So is that fair enough in terms of what?
Yeah. I mean, it's either franked sustainable trade finance or ESG. I mean, I guess ESG and the environmental, social, and governance, harks back to the longer term kind of debt, ECA financing, where there is, from a developed market perspective, more of a focus and interest in the environmental side of things. It's just further away from the developmental problems that sustainable and the developmental side of things are more relevant for.
Yeah, that makes sense. So how are banks adapting to the changing roles of the treasurer?
Thanks, Annie. So I endorse what my fellow panelist just commented. ESG is becoming an ever more important topic to the banks and across the other industries. So from my point of view, I believe ESG should be embedded in any bank system, and not only the banks, also across all of the corporate. Given that we are moving from nice to have to must have, and this is mainly due to the shift in the regulatory structure that's occurring. So to your question, how the banks can react, I think the banks, they have to start assessing the success of their business and the success of their corporate business through the lens of ESG. And that should be happen on the three factors that we have just alluded, the environmental, social, and corporate governance. And we should look at the three like equally important and look at them without ignoring any one of these factors. Also, another thing here that the bank, they have to set their own commitments, not only through their corporates, also through their own operation. As an example, in Barclays, we have set our commitments towards the Paris Agreement to be a net zero in 2050. We also already at net zero in our own operation. We have built a very strong diversity and inclusion, and that mainly on the race and ethnicity. Also, what we are seeing that the companies will be compelled to start disclose their sustainability exposure and to their financial. So that will give the bank the leverage to start incentivize the companies to give them a target. If they meet this target, then they can get rewarded. If not, they will gonna be penalized. Another thing, like for the past 10 years, we are seeing there are a lot of talks, development on the green. But post-COVID, we have seen a shift towards the S, the social, and this is mainly on the diversity, inclusion, and one of them also on the BLM that was like moving this factor, and the corporate governance to do some of the anti-bribery and the conflict of interest and all of these, etc., etc. And we have seen that the companies that they were doing well and have a sustainable agenda during the COVID, they are the ones who survived, did well, and they get rewarded from their shareholders or investors. Another thing that we have noticed that we are lagging off in the trade finance. All of the talks and development was on the debt and the money market loans. And what we are facing now, it is because of we ignored the supply chain or the sustainable supply chain. We are now living in a pit, in a mess in the supply chain. So this is another factor that we need to start working on it. And what we are seeing that the companies start now reviewing their strategy to make it more sustainable, agile, and transparent. Another things to react or to be ready for the ESG, we have to develop our own products as banks to be fit with the current changes and to help the client through the transition. I will give an example only on trade, not on the other.
Yep.
We in Barclays, we have 3 years ago, we launched the green trade loan. Last year, we have launched the Import LC, Green Import LC, Green Guarantees, and the Sustainability Linked Facility. We have also set a dedicated team to act as advisory to help the clients through their ESG transition journey. And we realize it's a journey. We learn as we go. And there are a lot of challenges, and there are a lot of works to be done to be ESG ready.
No, indeed. Look, I think if I can add from a bank's perspective as well, I agree with you. It's still an emerging concept, right? And I think we'll talk a little bit more about the challenges when it comes to ESG. There is discussion about sustainable supply chain finance now happening more and more with the corporate clients as well. But one follow-up question to what you said, when you talk about a sustainable letter of credit, right? For me, a letter of credit I've always known to be an MT 700. Right? So how does it change from a conventional to a sustainable letter of credit? Does it remain the same? How do you measure that this one will qualify as a sustainable letter of credit, whereas the other one may not qualify? Is there any can you give some advice around that or throw some light?
Okay, first we need to see if we will gonna here do the sustainability on the green or on another factors. So let's give example that we are doing that on the green import LC. So we have to support a project related to that. As an example, on the solar. So if there is a project in the solar and this project required some of the LCs, so here where we issue the LC, if you look at the LC itself, it will have the same characteristic as like, any other LCs. There is no any difference, but the underlying transaction and project, it has to be to support the, yeah. But internally, and this is something I think we do it for transparency and for our own MI data, and for also what I alluded earlier, when we, that the company, they have to start disclose their sustainable exposure, we have to do a separate facility. We don't do it with the normal facility, just for the MI purposes and for the transparency also.
Okay, thank you. So let's get Silvina, who's been a patient listener here, with us as well. So obviously you represent the fintechs, right, on this panel. So how do you contribute to this journey from a banker's perspective or from a treasurer's perspective? Where do you think, the fintechs are focusing on in terms of solving this problem for on sustainability?
Well, listening all what they are saying, what we can conclude at this point is that better data and disclosure really boost investment in sustainability or sustainable investment. And what we are seeing as Refinitiv is that there is a huge demand of data to solve all of the issues, to create products and so on. So what is still being an issue or a challenge is to get this data in the same format, standardized, with the same accuracy that any company publish its financial reports. So there is, even there much more relevance, and it's easier to get information from many companies right now. It's still a path to go through to get the data. Another company of our group, FTSE Russell, did last year a survey with 179 asset owners globally. The good news of that survey or research is that more than 80%, 84% of all of that global asset owners or traders are considering sustainability as a factor to take investment decisions and evaluate the portfolios. If we go back to first edition of the survey, 2018, it's like only 50%. So what we are seeing is like investment trade or investment in sustainability is mainstream, no? Probably the data changing between regions or markets, but it's been mainstream. When we go to the challenges, we three main outcomes from the same research. One is like 60–70% of the investors that participate said that the standardization and the disclosure of the data is still the biggest barrier to invest more. 45% of the same population said that quality of the data and consistency of the data is still an issue. And when we go in terms of understanding the investment between the E, the S, and the G, one of the main reasons that investors are not investing so much or banks creating products in the S is because the data related to social is harder to get comparing with the E at this point. So it is quite interesting results. We are seeing an evolution all over the years, but there is still work to do. So how the data and technology companies like ours can solve or help in this is to provide more visibility of the data, is to create more analytics of the data. One of the key criteria for us is the transparency and objectivity. So we only collect, and our database is quite strong in terms of, for company, we have more than 400 data points between the E, the S, and the G, so it's quite robust. But all the information that we capture for companies should be public information, is public information. So it's quite easy to track records, to audit the data, and to get all the information. The other important thing that we provide is the raw data database. So banks, investors, companies can elaborate their own investment portfolios, models, or whatever they need with the data. It's not just scoring, it's not just ratings or indices that we also have, but specific data. The last thing I want to add here is like I really believe that this is two-way conversation. So it's the investors part, but also it's the corporate part. So we help companies to gain visibility into the market. We have a technology, it's called Contribution Tool, which is a web page with user and password that companies can upload all the information. Then we check and we publish in our products. And this is very important because companies can access to a pre-template, so they understand what is material for the investors, the definition of each data point. So it's a process of education and learning, and they can publish the data and upload the sustainability reports and everything in the same place. More than 1,000 of companies all over the world are using the platform already. Our database includes more than 11,000 companies, but it's a small proportion between what we create on ourselves and what they contribute. But it's an easy tool to accelerate the process of gaining more data.
So that's good, because I think you're not just depending upon your clients to give you the data. What you're saying is that you already have access to a lot of data from third-party sources, which kind of reduces the burden on your clients to give you everything for you to run the analysis. So you have the data, you run the analytics, and obviously what the clients can give you would only add to your analytical tools, and therefore you will be able to give a better data output, a better analyzed output to your clients.
Exactly, and it's public tool. It's not need to be a client to get access to it, because we really want to create the ecosystem. On the other hand, we count like 20 years history in many of the data points. So for backtesting or data in time, it's quite significant. So we get the information from the existing annual report, but also we build the information and standardize. So it's one of the things, or how we can address these challenges that I mentioned before.
No, definitely interesting, and I think it's going to add a lot of value once we go down, right, this channel of, once the standards come in, right, I think this kind of analysis will also be helpful in sometimes even defining the standards, right? But we'll talk about that in a second. I want to come back to you, George. And I want to give a little bit of regional flavor to this discussion. Obviously, you being part of, based out of Africa as well, right? Are these trends same when it comes to ESG out of Africa? I mean, Africa is obviously the largest trading partner, one of the largest trading partners with Middle East. So it's very important and relevant, for when you're doing business with Africa. Do the themes remain the same? Are they different? What are you seeing from an ESG perspective in Africa?
So particularly in the trade finance space, we really do need to split developed markets and emerging markets. There is a tendency for the standardization to be driven by the developed markets, the established global banks, and their perspective is very, very different from the emerging markets and the realities of two very different products. So there is a tendency in those developed markets to take the same technology that's been developed and is very successful and very sensible in ECA, term debt, those kind of things, and just say that trade finance is short-term debt, and we can apply the same kind of certification. And then the problem is really just an information problem, and the answer to that information problem is almost certainly digital. I think there may be a significant issue with taking that stance and trying to apply it to particularly emerging market trade finance. I think it works very well, and the ICC paper looks at the 5 dimensions of a trade transaction and the sustainability credentials of each of those 5 dimensions to give it a score, and that's very sensible and it, can work well in developed markets. In emerging markets, that's just simply not what we're dealing with. The ballistics of the product are entirely different. The tenor is much, much shorter. The amounts are much smaller. It's all paper-driven. And it just doesn't transfer well to trade finance, particularly if you focus on the environmental credentials. And that's people tend to say green. They'll want to say green rather than sustainable. They'll want to say ESG rather than sustainable because, from that perspective, from the developed market perspective, that's what you're looking at. You're looking at carbon neutrality, and that's where the mindset is. Whereas, in these markets, and particularly, Africa as an emerging market, the sustainability point is really, really important. There's a $100 billion trade gap. We desperately need those investors to deploy their ESG dollars into the trade finance in Africa to reduce that trade gap and deliver to the sustainability goals, those developmental and economic and inclusion sustainability goals. And we're not going to get there using the same formulas as the wise and established, particularly trade financiers in global banks, are going to want to do from Washington and London. There needs to be a keener understanding of the product and how it differs from longer-term debt, as well as differentiating the realities of the underlying sustainability within the trade assets in those emerging markets. It's a challenge, but this is a very fertile time to be talking about this, and there is a sense that the tide is maybe turning back. The ICC, put forward this positioning paper, which is very, very, very good, as I say. But there seems to be a bit of a resurgence of the emerging markets saying that we maybe need to look at this differently. Digital is almost certainly the way, ultimately, to capture all that information. But right now, it's just not a realistic proposition.
Yeah. So coming back to Vineet, then, we've heard a lot of challenges, right? Some are getting solved through data. We talked about, what banks are doing, but lack of standards as well. Some of the challenges that Josh talked about. So from your perspective as a treasurer, how would you want the ecosystem around you to change so that you become more successful looking at sustainability in your role? Yeah,
I think end-to-end traceability is something which is basically, or also application of as you say, the digital channel. Because if you see in the trade finance, certain countries have adopted the e-bill thing, but a lot of places not there. So it cannot be applied anywhere. You can only have few, including UAE. I think Abu Dhabi, they have also adopted EBL. So I think the regulation, the custom regulations of individual country also plays part in that. In terms of basically actually challenges as a treasurer, as an organization, I think there are two types of challenges. One is the internal. Internal is basically sometimes you have to justify the initiatives because sometimes it is seen like as a cost, as a basically more cost to the corporate, though you get the benefit later on. So basically to convince that this is a sustainable way and then you will be better off in long term. So which is, I think, thankfully, most of the corporates, we are now that much aware, we are past that problem, and then even boards are mandating this for ESG. The second problem, which I feel is external, which basically I would say that the floor is not set. Like, the ESG is basically rated for different stage to different. So basically, when you start a ESG program or you take a sustainability linked credit facility or any transaction, today one corporate could be below maybe in the negative territory, so doing too much of emission, and one corporate has already adopted certain things and reached to a particular level. Now, if this corporate who has reached to a particular level, he has to go further up to get any benefit from that program, while the corporate who is actually below it can have a quick win because it can change things and then get benefit. So basically, there should be I would say, equalization kind of thing, whereby you say, okay, because you are already in such stage, you start from a better pricing anyways, and if you improve further, you get more benefit. And because you are not up to that mark, so you basically get a higher pricing, and then you have to come to this level to re-equalize to this corporate level, and then so basically both are incentivized. Otherwise, I have had one of my discussions, I said, we have already done this implementation, so you give me a better pricing anyways. They said, no sir, you have to go further. I said, then I'm actually feeling that I should have not done until this can happen. So I think this is one thing which I would expect from banks to come up and basically create a level playing field, that corporates who are without getting into these kind of incentive, they are themselves and going and then adopting ESG practice and reaching to a particular level should also be getting benefit. And then further they improve, they could. So that's one thing. And also actually defining, this would also come to defining the standards, correct? So where are you in that journey from where you basically are too much, carbon emission, corporate or maybe social side, you have to improve too much on the governance side, and where you already have reached to a place. So basically you basically define a stage. So this corporate is stage 5. So this pricing applies to the corporate, then stage 3 gets a better pricing anyways because you're already in stage 3. And then if you reach to stage 2, you will get even more. So this, I think this would kind of standardize everywhere that how to look about it. This is one thing I would basically expect to develop, as we go along. Clear definitions of, what is linked to which type of, sustainability. So environmental, because for us it's like basically we don't only reduce the carbon emission, we basically even do the regenerative agriculture. So through the, through a process. So basically we basically also store CO2 in the land by doing that way, and basically so we don't only reduce but we actually contribute towards the environment. We also work with farmers, so basically we do on the social cause. So basically we provide them financing before the crop like that. So basically there has to be very clearly defined how you can, which category you can define it and where basically you will be rated based on those initiatives you have already taken. On the trade finance, and I would like to add on what you were saying on the digital thing. Basically the problem I think comes for any bank or any financer to finance a trade finance transaction is basically they don't have the full visibility of supply chain, correct? From the origin of the thing and then ultimately buyer. So how basically the whole procurement to really ultimately it converts into cash. So basically I think, and that's how basically a little bit hesitant banks become, that they don't know whether it's a real transaction or it's just a billing, or it's basically how can they trace the full entire supply chain. So I think that is a one thing, and that would also involve all the stakeholders. So like shipping lines come on that platform, banks come on that platform, even the customs of the various countries would also be linked. So basically they all accept the electronic BL and all those stuff. So I think that is also a challenge. For bank side, I think they have to come up with more, they need to come up with the better products, or actually maybe more variety of products which can apply to different type of corporates into their basically industry they are in. And then basically they can associate themselves, or they take advantage of that. So I think ESG has to be done anyways, basically. Even if you don't have benefit, it's a benefit as a collective benefit for the world, because we are changing the way we work, correct? And then and same time trying to be profitable. So we don't want to basically go away from a profitable organization to a non-profitable for the ESG. We want to have both things together, doing it in a responsible way. And I think everybody has to basically contribute on that. I think fintech can definitely contribute on that tracing, that traceability. So basically where exactly it's originating, what type of labor was used. So all those information to make it like, ticking all the box.
Okay, good. So I think we've got about 6 minutes left, and I do want to have 2 questions to cover. I think you raised an important point again in terms of how do banks rate corporates. So today, for example, if you look at a credit rating model of the banks, most banks would have a uniform rating model, or at least similar, and therefore their assessment about the credibility of a client would be similar. If it comes to compliance risks, most banks again, would have a model. But for ESG, I don't think banks have one, right? That's because again there is a lack of common standard as to how we can rate clients on the basis of their ESG, and there's lack of data, there is lack of standards. But talking of standards particularly, I think Georgie also mentioned about ICC standards coming in, and ICC has recently, I think in November, issued a paper on sustainability specific to trade finance. I personally, when I read the paper, I was very happy because at least that sets a good baseline in terms of what sustainable trade finance looks like. So can you please, Serena, talk a little bit about this paper? How does it help the banks, especially in terms of addressing the standardization related issue?
Yeah, sure. Before that, maybe I wanted to give some data why it is very important. So global trade is equivalent to 60% of the global GDP, and a global supply chain is contribute to 80% of the carbon emission, the global carbon emission. So if we didn't do anything on the trade finance, the sustainability cause is lost. So the ICC, they have acknowledged that there is a lagging off that I already alluded in my previous comment. They have realized that the urgency, they have to do something, and it's key for a global body like ICC to set the standardization. They came up with reports in November. It's only draft at this stage. They did it with the major trade banks and some of policymakers and stakeholders. They share it with the banks and with other bodies to see what is their comment, and this is something very important because, as I also alluded, it's a journey, and each one they have a different experience, and we see some of the banks, because of the jurisdiction where they operate, ESG is priority. So you see them ahead of the curve, and some of the banks still behind of the curve. So by setting the definition and the standardization, I think all of my fellow panelists, they have mentioned on the standardization, it's very important. They will create or build a confidence. It will be used as a reference, even for the banks that they still starting in that in the journey, they need a reference. And all of us, when it comes to the trade finance in any banks, locally, internationally, we use the ICC when we put our process, our best practice, we use it as a reference. Even when we do our own framework on any products, we use it as a reference. So as this, we are moving towards this, the ESG, in this transition, we need ICC to facilitate that to us. They did that. So I am quite confident that all of the banks, they use now the ICC Sustainable Trade and Trade Finance when they do the transition towards the ESG.
Okay, that makes sense. So we've got last 2 minutes before we open up for Q&A. So Silvina, I want to come to you. When we were chatting earlier, you talked something which caught my attention, which was the green revenue model, which you talked about. Can you talk to us a little bit more about what this green revenue model is?
Sure. So green revenue model is just an example of our response to a change or evolution in the data demand. So when all of the process to go on sustainability start, the focus was on operational, the operations of companies. But what we are seeing after many time and how it is evolving is there is much more focus in terms of the products, the services, and the supply chain that you mentioned already. So it's different way of getting data and understanding data and elaborate models with that data. So the green revenue model is, to be in 2 minutes, very simple. It's how we can measure the impact, the portion of revenue that company generates that have a positive impact when we talk about green. So the companies that can be analyzed considering what they are doing in terms of climate change and adoption, in terms of water, in terms of uses, resources, in terms of agriculture efficiency. So the idea is to track from the performance of a company what depends or what are the outcomes came from green activities and generates green revenues. And this is a tool that helps on the transition, on the analysis, on the investments, and so on.
Very, very interesting, I think. So I think, do we have any more questions? I think we've got about 10 minutes left from the audience, if you're able to take any questions.
I have questions, but I lost my mic, so I just lost here.
We got one question coming in there as well. So,
First question that Jeff sent me is, how can banks reduce funding of hydrocarbons, fossil fuel, in a region so dependent on oil? That's the million-dollar question, I guess.
do you want to take it? And maybe I can add if required.
No, we have to keep supporting the oil and gas. We cannot say we cannot. But the way what I mentioned, we need also to incentivize them to do something on the green or on the sustainability. So we will remain supportive, but with a different structure, which we're not going to give them already. We limited the limits on the oil and gas. We already reduced on some of these sectors, especially on the companies that they don't do anything on the sustainability or on that, agenda. And there are a lot of technology, a lot of initiatives that can be done on the oil and gas. Yes, it is a problem, but at the same time, there is a lot of solution, and they can do a lot to create a sustainable world. So for us, if any oil and gas, they don't do anything in the sustainability, we will not gonna support them similar as what we used to support them. But if they continue to present the certification and show that they do something there, they will gonna be rewarded, and we will gonna continue to support them.
Wonderful answer. Really amazing. And in fact, the UAE is very successful in diversifying its economy, particularly Dubai, as we can see. Second question, Annie, for your wonderful panelists. Is financing cheaper, lower rates of interest on sustainable projects? That's another million-dollar question, yeah?
Yeah, we keep on getting this all the time from our corporate clients, so I'm not surprised we've got one here. So look, I think the various things that banks are working on to reduce the cost of funding coming in. I think there are various secondary market asset players as well who are now interested in sustainability-linked assets, and with their own KPIs associated with sustainability, the banks are able to probably raise cheaper funding, which will definitely be passed on to the clients.
Wonderful. Anyone else want to chip in? Please.
If I can add on that, when we talk with investors particularly, they mention that mitigate risk is the main driver of including sustainable investment decisions. Reputational risk, second, and low in the list is profitability or differentiating from winning on the sustainable at this point.
Great. Anyone else? No? Well, actually, it'll be interesting tomorrow because we have the EBRD and the IFC here tomorrow. And their two priorities are, number one is sustainable finance, and number two is digitalization. And they have some very nice, attractive offers for the banks, and even in terms of the tenor they're covering now. So we'll hear about this tomorrow. I have two more questions. Is that okay?
Yeah, of course.
Okay,
I think you got one more there as well.
I have one.
So there's one question.
One here. Please, go ahead. Go ahead.
Good afternoon, everyone. This is Pankaj from 360 TF. I think very interesting session. I just want to know, like, from the players which we discuss about, and especially we discuss about Moody, S&P, and Fitch have raised sustainable, analytics, and Morningstar have sustained analytics, right? So how do we rate what Refinitiv is doing, and how you think what Fitch is doing, because they also claim to have the strong platform. So have we analyzed or think that the way Fitch has come in, you think S&P and Moody will also follow?
So I was not sure, Pankaj, whether I could understand your question. Your question is that different agencies
so there are two
have got different
platforms.
ways of looking at sustainability-linked analytics. How do you adopt which one? Is that your question?
So I'm saying the Fitch have already, launched the, sustainable analytics.
Yeah.
Morningstar US have launched, and I'm sure Refinitiv will be competing with them. So how do you see how they are, Refinitiv is competing with them? And do you think, like Fitch, Moody and S&P will also follow?
Okay. Do you want to take this question? I have some views, but by all means, if you
Sure.
want to
No,
start.
what I want to add is our main asset is the data and the community, and how we bring the data together, working directly with the companies, and the possibility to each institution, exchanges, banks, investors, regulators to access the raw data points, to elaborate their own models, to elaborate their own ratings, to elaborate their own scorings in a much broader audience. And really we are seeing totally different demand and usage of the data. There are many, many different use cases. Probably some of the companies he mentioned are fit on the investor side, but we have regulators that they are tracking what is happening in the market. We have in Latin America central banks that want to create a green monitor of what the companies are doing in the carbon market, for example. So there is a lot of use cases, and we work in a partner with all of these entities to build the database and the analytics they need. It's quite flexible in that sense.
Yeah, I agree. It's such an evolving phase right now of these analytics. There are some models which have looked at, for example, as Silvina mentioned before, looked at the data and come up with their own standards of either rating or giving a rating. There are others who are still co-developing this along with the ecosystem. So there are a few fintechs, for example, that we are looking at exploring where they have got the banks, they've got the regulators, they've got fintechs, they've got corporates in there, and everybody is kind of contributing to coming up with a database. So I think there are various models which are coming up. I think there is enough, room and space for everybody to come in. Again, I think we talked about lack of standards. If you have a standard, then it becomes easier for someone to rate and give kind of a common rating or come to a similar rating. But due to lack of standards, I think there will still be room to kind of adjust some of the work that is happening in this space.
That's wonderful, and I have another one or two. And the next one is COP26 was a major, even though mixed outcome. Will trade have a seat at the table for COP26 in Cairo and COP28 in the UAE? Is trade that important with the policymakers? That's the question, not mine.
Want to take this, George?
Well, certainly with the governments from an economic perspective, probably from a developmental mandate perspective, but then there seems to be, quite a lot of forgetfulness as soon as people start talking about the environmental, particularly side of things. And COP26, made some great progress in very important ways. But I mean, a couple of statistics, or at least one, of all of the global emissions, Africa accounts for just 2%.
Oh.
Right. So there is a great concentration on particularly carbon emissions, and particularly out of COP26, and it's obviously of enormous importance. It's just maybe those policymakers are not concentrating on the emerging market effects and the other sustainability goals, that need to be brought into line.
But if they want my vote is yes.
Wonderful, please go ahead.
I was going to say my vote is yes to have a trader seat.
Oh, okay, Annie, okay, I'm with you. And the final question, people have started asking hard questions because nobody knows who's asking them. It's not me, okay? So the last one I've got, what to do about child labor? If stopped, families will go hungry. Well, I don't know how to answer that or whatever, but it's kind of a good question. Anyone like to take it?
Yeah, there are other things to do other than to use that child for, let's say, for the farms. There are a lot of things to do. So if we continue to do the restrictions on the child labor, they will find the alternative.
Okay.
Yeah.
I grew up on a sheep farm in the west of Ireland.
Vincent?
Yeah. Oh, sorry.
Vineet wants to add something.
Apologies.
Yeah, I think the problem basically what happens is that, I'll just take an example of farmers, they have to put child labor and whatever it is, because they don't have the capital to deploy at first, correct? So they have to first, so basically they would want to put the labor and whatever they can do free, whatever they are available to them. So if there is a way of trade finance, which basically can provide initial capital to them, probably they will be able to, not put the child labor and basically deploy the normal labor, and then basically, so I think it's again part of the whole transition whereby you basically have heard basically a term of deep discounting. So it's not only buyer and supplier. So basically you go to the supplier and then ultimately to the originator. So basically whatever discounting you are doing is reaching to basically the origin of that. If that can happen, obviously you can support this cause for sure. I mean, that's just a thought came to my mind that the trade finance can really go deep into that supply chain line. management support.
Wonderful answer as well. The ADB have a program like that now in Bangladesh, kind of diversification of the labour market. So a wonderful panel, you and your panelists. Any final remarks? But it was really, really great.
Well, I just want to thank all my panel members for being here, and I think we are not on time.
Yeah, you did a great job. Okay, give them a good round of applause, everyone.
Thank you very much.
Really great.